Hello, everyone. I am Liu Zhongwu, an experienced analyst from Aid Financial, and today I will be discussing the detailed investment strategy for US stocks in the year 2025. Today, we will primarily discuss our strong expectation that the S&P 500 index will reach an impressive milestone of 7,000 points by the year 2025. Today, the content I will cover consists of 6 essential main parts that are important to understand. As is customary, we will first take the opportunity to present our essential and core viewpoints for your consideration. First, we have thoroughly analyzed the overall performance of both Trump and Biden throughout their respective terms in office, considering various political, social, and economic factors. During Trump's term, the S&P 500 outperformed Biden's by 17 percentage points. In terms of overall consumer confidence levels, Trump's first term in office also scored significantly higher than Biden's first term, reflecting differing economic perceptions during their presidencies. The second viewpoint is that the Federal Reserve, during its last FOMC meeting of 2024, raised its economic growth forecast expectations for the year 2025, indicating a more optimistic outlook. This strongly indicates that the officials are quite confident about significant economic development in 2025. In terms of the nowcast model for predicting economic recession, the probability of recession in the next 12 months has decreased from a previous high of 71% to 34%. This indicates that the likelihood of systemic risks occurring in the financial system over the next 12 months has significantly decreased. A soft landing for the US economy is highly likely. The probability of the S&P 500 index rising without experiencing a recession is 84%. The third point to consider is that the significant increase in US stocks over the past 25 years primarily stems from 3 sources. First, money market funds, which play a crucial role. Second, the siphoning effect on global capital in a high-interest, strong dollar environment is exacerbated by the significant impact of over $1 trillion in corporate stock buybacks, which further intensifies market dynamics and influences investment strategies across various sectors. The fourth point we would like to emphasize is that we firmly believe the potential for substantial valuation increases in US stocks over the next 25 years is rather quite limited. However, the potential for earnings growth will be greater. We expect the S&P 500 index to reach 7,011 points by 2025, representing about a 16% upside potential. The fifth point to consider is that we maintain a cautiously optimistic stance regarding US stocks in 2025, and we continue to hold a positive outlook on Bitcoin's potential. What about gold? Furthermore, reflecting on the developments anticipated in 2024, we have significantly increased our focus on the 7 major US technology companies, Berkshire Hathaway, and the ARK ETF, identifying them as our top investment picks for 2025. Now let's take a closer look and delve deeper into each of the essential core points we just discussed in order to gain a better understanding of their significance and implications. Let me explain. First, let's take a closer look at Donald Trump's previous term in office. We can do this by thoroughly analyzing key economic indicators, such as consumer confidence levels and the performance of the S&P 500 stock index during his presidency, and then comparing these metrics with those observed during Joe Biden's presidency. This comparison will help us better understand the economic landscape and the impacts of each administration's policies on the market and consumer sentiment. During our analysis, we discovered that throughout Donald Trump's presidential term, the average consumer confidence index for Michigan stood at 93.2, which is notably higher than the 4-year average of 68.8 recorded during Joe Biden's administration. This indicates a significant difference in consumer sentiment between the 2 periods. This suggests that consumer confidence levels were notably higher during Trump's presidency in comparison to the term served by the 2 previous presidents. Now let's take a closer look at the comparison between Trump's previous term and Biden's current term. When examining market performance closely, we find that among the various sectors of the S&P 500 during Trump's presidency, only 3 sectors experienced worse performance compared to the first 3 years of Biden's presidency. This highlights the differing economic environments and impacts of their respective administrations on the stock market. However, the overall performance of the information technology, consumer discretionary, utilities, and healthcare sectors was truly outstanding and impressive. The lowest performance recorded exceeded Biden's results by a notable 9 percentage points. 9 percentage points. Overall, the S&P 500 index during the first 3 years of Trump's presidency notably rose by an impressive 14%. In contrast, during Biden's first 3 years, it increased by 27%, surpassing Trump's by 17 percentage points. Overall, Trump's presidency saw notably better market performance and significantly higher levels of consumer confidence compared to previous administrations, contributing to a more optimistic economic outlook during his time in office. Therefore, we fully expect that after Donald Trump officially takes office on the 20th of this month, his overall performance and effectiveness over the next 4 years will also be quite positive and beneficial. In Trump's second term, his primary policies concentrated on 4 significant areas, one of which is the implementation of tariffs aimed at protecting American industries and promoting domestic production. This is primarily due to the long-standing trade deficit in the US, and the outsourcing of the supply chain has led to rising unemployment among American workers. The Trump administration aimed to strategically guide manufacturing jobs back to the United States through the implementation of tariffs, which were designed to protect domestic industries, ultimately providing more job opportunities for American workers and fulfilling his campaign promise. However, we firmly believe that the Trump administration will gradually raise tariffs over time through careful and strategic negotiations with various trade partners. This situation will not lead to a sudden spike in inflation levels in the US economy. The second significant policy initiative of the Trump administration focuses on implementing domestic tax cuts, along with a comprehensive approach to deregulation across various industries. Tax cuts, as we know, can effectively stimulate economic vitality and significantly increase corporate net profits over time. The government reduces this regulation, which can lower government spending and improve efficiency, benefiting the economic development of the United States. The third policy is to restrict illegal immigration. We firmly believe that the restriction on illegal immigration should not be viewed as a sweeping blanket approach aimed at deporting all individuals living illegally, but rather as a careful, gradual process that addresses various circumstances. The process will be carried out methodically, step by step, to deport these illegal immigrants. Furthermore, the deportation efforts will initially focus on those illegal immigrants who possess criminal records or have committed serious offenses. Then it will gradually begin to extend its reach to include other illegal immigrants as well. Labor costs may rise significantly, which could also contribute to increased inflation rates overall. However, this particular aspect is relatively controllable. It certainly doesn't mean that all labor will be completely eliminated at once. Additionally, the US federal government may also modify existing immigration laws and regulations. On one hand, it advocates for the intake of high-quality legal immigrants. On the other hand, it aims for large-scale, orderly handling of illegal immigrants. The fourth key policy of the Trump administration is to actively support and promote traditional energy sources. This particular aspect notably differs from the 4 years of the Biden administration's policies. The Biden administration generally tends to actively support and promote green energy initiatives. The Trump administration supports traditional energy over alternatives. The reason is that the US possesses the largest oil reserves and highest levels of production compared to any other country in the world. He actively develops this traditional energy, which can lower oil prices. This particular aspect is quite beneficial for managing inflation, as it indicates a potential decline in inflation rates. In other words, when considering these 4 main policies, it is highly probable that their implementation will occur effectively and efficiently in the near future. During this pivotal election, Trump not only won the presidency by a significant landslide, but he also garnered overwhelming support from his dedicated voter base. But he also gained significant control over both the Senate and the House of Representatives. During the initial 2 years of his administration, implementing those significant policies tends to be relatively straightforward. Next, let's take a closer look at the official perspective regarding the state of the economy projected for the year 2025. The official source is mainly the Federal Reserve. In the final Powell meeting of 2024, the Federal Reserve raised its economic growth forecast for 2025 slightly from 2% to a slightly improved 2.1%. In relation to employment trends, the unemployment rate forecast for the year 2025 has been adjusted downward from 4.4% to 4.3%, which indicates the Federal Reserve's strong confidence in ongoing economic growth and recovery in the labor market. How does the Federal Reserve view and interpret inflation in the current economic climate? Whether we are discussing the personal consumption expenditures, PCE, or the core PCE, both metrics have experienced slight upward adjustments from their previously low levels, indicating changing economic conditions. This may indicate that the potential for inflation to rise significantly due to Trump's policies and decisions is being carefully factored into economic forecasts. The federal funds rate has recently been increased significantly from 3.4% to a higher level of 3.9%. Market expectations firmly suggest that interest rates will likely decrease in 2025, 2 to 3 times. Through these comprehensive official reports, we can generally observe the various changes in economic growth, trends in inflation, and the anticipated target interest rates set by authorities. In the short term, these fluctuations are likely to cause some disturbances and volatility in the market, potentially impacting investor confidence and market stability as participants adjust to the new economic indicators and forecasts. However, in the medium to long term, it is indeed quite beneficial for the sustained and healthy development of the economy, fostering growth and stability in various sectors over time. As long as the economy is steadily improving and showing positive growth, the stock market can continue to thrive successfully. The economy serves as a crucial barometer that significantly influences the fluctuations and trends observed in the stock market. Let's take a closer look at what the US economy is projected to be like in 2025, discussing whether it will experience a soft landing characterized by gradual recovery or a hard landing marked by a sudden downturn. So far, the Federal Reserve has cut interest rates 3 distinct times, successfully lowering the federal funds rate to stimulate economic growth. However, due to the strict policy in place, the substantial restrictions still continue to exist and affect many individuals. Reducing inflation continues to be one of the Federal Reserve's primary goals and objectives. Let's look at the chart in the upper left corner. One line represents the International Monetary Fund, and the other line is the Federal Reserve's forecast for real GDP growth from 2024 to 2027. These two respected institutions predict that GDP growth will generally range between 1.5 and 3% over the next 3 years, indicating a moderate economic outlook. In developed economies, the GDP growth rate can consistently maintain around 1.5%, which allows us to observe and analyze the various GDP growth predictions provided by both the Federal Reserve and the International Monetary Fund, reflecting their economic outlooks for future performance. Another detailed chart located in the lower left corner distinctly illustrates that the New York Fed has developed a sophisticated predictive model specifically designed for forecasting economic recessions. The likelihood of a recession in the next year is currently 71%. The trend has declined to 34%. This indicates that the probability of systemic risk happening in the US financial system has notably diminished over time. The chart in the bottom right corner is sourced from the Federal Reserve. The high card prediction model's forecast is here. According to this model's predictions, we can see that the actual GDP growth in the US for Q1 2025 is 2.1%. That's very good, very good. Based on a thorough analysis of these extensive models and relevant data, we can clearly see that the US economy is projected to achieve a significant level of growth by the year 2025. It is a highly probable event. We also conducted a comprehensive statistical analysis spanning from the year 1972 to 2024, which covers an extensive total of 53 years of data collection and evaluation. In these 53 years, there were a total of 15 challenging years of recession. In each year marked by economic recession, as highlighted in our previous detailed reports, the S&P 500 index consistently experienced varying degrees of decline, reflecting the tumultuous market conditions during those times. Additionally, during this period, there were a total of 38 years without a recession, out of which 6 years experienced economic declines, while an impressive 32 years enjoyed significant gains and growth. The probability of gains is 84%. In the impressive 38 years without experiencing a recession, the median annual growth rate reached an impressive 13.41%, while the average annual growth rate stood at 10%. 09. Through this page, we can clearly see that in the year 2025, you may have the opportunity to give it a try. It could be an interesting experience worth exploring further. With 2025 approaching quickly, this is driving the S&P 500 and the overall market to keep trending upward consistently. What exactly is the driving force behind this particular situation? There are primarily three key aspects to consider. Firstly, money market funds. Secondly, corporate buybacks. And finally, the movement of global capital across markets. First, let's look at incremental funds, money market funds. In the past few years, the overall balance of US money market funds has been steadily and continuously growing, as clearly shown in the lower left corner of the chart. When we pull up this detailed chart, we find that both retail and institutional clients' investment holdings have been steadily increasing over time. This upward trend indicates growing confidence in the market. By December 2024, the total amount held in money market funds is anticipated to reach approximately $6.8 trillion. That's a lot. Now, as we examine the detailed chart located in the lower right corner of this presentation, it clearly illustrates the significant changes in interest rates that occurred following the release of the dot plot data from the recent BOSMA meeting. For the 2025-2026 period, the federal funds target rate is projected to decrease by 100 basis points in 2025, followed by a further decline of 50 basis points in 2026. Historically, the flows of money market funds have demonstrated a significant correlation with changes in the Federal Reserve's interest rate policy, reflecting how these shifts influence investor behavior and market dynamics. This indicates that as the Federal Reserve begins a rate-cutting cycle to stimulate the economy, the yields offered on money market funds are likely to keep decreasing further. To achieve higher financial returns, many investors will likely move their funds out of traditional money market funds, potentially directing that capital into US stocks for better growth opportunities. A potential option is investing in US Treasuries. If the funds significantly flow into US stocks, it will likely drive the overall performance and growth of the stock market considerably. If substantial funds flow into US Treasuries, it will lead to a decrease in the risk-free rate, which will subsequently enhance the overall valuation of US stocks. In other words, whether the funds shift out of money market funds and into US stocks or US Treasuries, it will ultimately have a beneficial impact on the performance and growth potential of US stocks. The second incremental funding is the inflow of foreign capital. The inflow of foreign capital largely relies on the specific policies implemented by the United States government. One significant aspect to consider is the monetary policy, which underwent a shift in September 2024 from a tightening phase to a more accommodating easing cycle, thereby increasing the overall attractiveness of the US market. The US government is focusing on large-scale industrialization as part of its fiscal policy. These comprehensive policies, whether they are monetary or fiscal in nature, are expected to have a significantly positive impact on the inflow of foreign capital into the US economy. In the second aspect, the Federal Reserve has made significant progress in effectively controlling inflation rates and stabilizing employment levels, which are crucial for maintaining a healthy economy and ensuring that job opportunities remain accessible for the workforce. Furthermore, the market generally anticipates that the US economy will not face a recession during the year 2025, indicating ongoing economic stability. Economists working on Wall Street are no longer actively discussing the potential possibility of an economic recession occurring. The International Monetary Fund has made a forecast predicting that the growth of the US GDP will reach 2.2% in the year 2025, which is notably higher than the growth rates anticipated for the Eurozone, Japan, the United Kingdom, and various other developed economies around the world, except for Canada, which has a significantly smaller economy overall. Canada's capacity to attract foreign capital is somewhat restricted, making it less competitive in this area. However, when we compare the US with other major, larger economies, it becomes clear that the US continues to maintain a higher level of foreign investment overall. Other economies are expected to have GDP growth below 2% in 2025, while the US is at 2.2%. With accelerated economic growth, it naturally presents a significant advantage, drawing investments and financial resources to flow into economies that are experiencing rapid expansion. Another important aspect to consider is geopolitical conflicts. Ongoing conflicts include the Russia-Ukraine war, the Israel-Palestine situation, Libya, and tensions in the Asia-Pacific region. There are still some ongoing localized conflicts or wars in various regions. In the current global economy, it is still facing a number of uncertainties and challenges that impact growth. These funds and capital typically seek safer, more secure, and stable investment environments to minimize risk and ensure steady returns. The United States, as a country, basically has no wars domestically, making it relatively stable, and its market is quite mature, which is one of the reasons attracting foreign investment. Now, let's take a closer look at the detailed chart located in the lower right corner. This is a detailed chart we carefully compiled. In 2023, the net inflow of foreign capital into US stocks was $21 billion. By the end of 2024, the impressive net inflow in just 10 months reached $162.6 billion. We firmly believe that, given a combination of several favorable factors, the United States continues to exert a significant siphoning effect on global markets, especially considering that the current US dollar index is essentially hovering around 108. The interest rate on US Treasury bonds, particularly the yield on the 10-year Treasury bonds, is currently above 4.5%. We confidently expect the ongoing trend of net purchases of US stocks to persist throughout 2025, building on the strong net inflow trends observed in both 2023 and 2024. The third aspect of this incremental capital is corporate buybacks. Let's first take a closer look at the chart located in the lower left corner, which illustrates two distinct indices for comparison. One notable index is the S&P 500 Buyback Index, which consists of 100 carefully selected companies chosen from the larger pool of 500 firms within the S&P 500 index. Here are the top 100 companies ranked specifically by their stock buyback activities. From a historical perspective, the S&P Buyback Index, which tracks companies that repurchase their own shares, has demonstrated a long-term return rate that is typically higher than that of the S&P 500 index, as clearly illustrated in this informative chart. This trend underscores the potential benefits of share buybacks in enhancing shareholder value over time. Additionally, Goldman Sachs anticipates that by the year 2025, the total amount allocated for stock buybacks will reach an impressive $1.08 trillion, which reflects a notable 16% increase year on year. Furthermore, this buyback amount is set to reach a new historical high, surpassing previous records. The various benefits of stock buybacks include the ability to significantly increase shareholder value, while also signaling to the market that the company's stock is undervalued, which effectively boosts overall market confidence in the organization's financial health and future prospects. It can also enhance earnings per share, optimize capital structure, and provide various other advantages. In other words, we observe three significant factors at play in the financial landscape: money market funds, foreign capital inflow, and corporate buybacks. These three key aspects are contributing to the influx of incremental funds into the US stock market, which in turn is driving the S&P 500 index steadily upward, reflecting growing investor confidence and positive market momentum. Now, let's take a moment to briefly review the overall performance of the US stock market in the year 2024. After the thorough review, we will confidently make a prediction for US corporate earnings. The year 2024 will undoubtedly emerge as a leading bull market, showcasing significant growth on a global scale. In terms of major broad market indices, the Nasdaq surged about 35%, slightly surpassing the S&P 500's 27% and the Dow's 15% gains. The Russell 2000, representing small cap stocks, increased by 10%. In this specific sector level, four distinct industries notably outperformed the overall S&P 500 index. One is communication services at 43% and information technology at 41%. Consumer discretionary is at 36%, and the financial sector is at 30%, exceeding the S&P 500 by 7%. The remaining sectors, aside from materials, which notably experienced a slight decline of 0.1% over the past 4 years, are all currently demonstrating positive growth trends. This indicates a robust recovery and improvement in various areas of the economy, reflecting overall progress. Overall, considering all factors, we remain optimistic about the strong performance observed over the past 5 years. Whether considering the overall market index or examining specific sectors individually, we maintain a positive outlook on their future performance and growth potential. Okay, after reviewing the performance of 2024, let's take a look at the earnings of the US stock market and related forecasts. To assess US stock earnings effectively, we conduct our analysis using the S&P 500 index, which serves as the most representative indicator of the overall US market performance. This comprehensive analysis will provide a detailed forecast for the entire US market and its various sectors. In the third quarter of 2024, the revenue growth rate for US stocks was 5.7%, exceeding the second quarter by 4.71 percentage points. It also surpassed the median of 5.4 since 2010. Considering the observed trend after hitting a remarkable historical high of 22.2 in the third quarter of 2011, it subsequently began to decline steadily, as illustrated in the lower left graph. By the fourth quarter of 2023, after experiencing a significant downturn and hitting rock bottom, there has been a gradual and cautious recovery in the market. It has shown signs of stabilization after enduring a full year of 4 consecutive quarters spent at the lowest point. The graph displayed in the lower right corner vividly illustrates that the earnings per share, EPS, for the third quarter of 2024 experienced a significant increase of 8.1 when compared to the same period last year. This marks a notable turnaround from a negative EPS of 1.1 in the second quarter of 2024, transitioning successfully into positive territory. Earnings are growing at a rate of 8.1%, surpassing the revenue growth rate. The company's revenue growth stands impressively at 5.7, which is considered quite high. This notable earnings growth, also referred to as EPS growth, surpasses the median level recorded over the past decade and exceeds the overall earnings figure for the year 2020. Through this analysis, we can clearly see that the US stock market has significantly improved and is showing positive growth trends. Another important indicator, known as ROE, for the third quarter of 2024 stands at 17.8%, which remains unchanged compared to the previous quarter's figure. However, it will be significantly higher than the 20-year median percentage of 14.3% that we have observed. If we use the DuPont analysis, ROE can be further broken down into net profit margin, total asset turnover, equity multiplier, and leverage. These three levels. In the third quarter of 2024, the S&P 500's net profit margin is 12.9%, which is a slight increase from 12.5% in the second quarter. However, it is also notably above the 10-year median and significantly higher than the 20-year median, indicating a clear upward trend. Trend analysis can be seen in the chart in the lower left corner. The current trend clearly indicates a strong upward potential in net profit, suggesting that future earnings may significantly increase over time. Overall, it reflects that the US stock market is currently relatively stable and consistent in terms of generating profits over time. Now, regarding our earnings discussion, let's take a closer look at the current valuations in the market. In 2025, the Trump administration plans to impose significant tariffs and implement strict measures to restrict illegal immigration. Such policies will undoubtedly have a significant impact on the overall market. We expect that in 2025, the US stock market will shift from a bull market to a small bull market, transitioning to a small bull. Now, upon closely examining the detailed chart in the lower left corner, we can observe that the current valuation of the S&P 500 is situated at a historically elevated level, and we anticipate limited upward potential for its valuation as we move into the year 2025. However, as the Federal Reserve enters a rate-cutting cycle with tax cuts, deregulation, and advancements in artificial intelligence, the efficiency and profitability of these companies will see significant improvements. In terms of overall profit growth, there is significantly more room for improvement and development. By the year 2025, the potential for an increase in valuation appears to be somewhat limited. However, the opportunities for profit growth are expected to be considerably greater. According to the latest Bloomberg data, the current price to earnings, PE ratio, for the S&P 500 index stands at approximately 23 times. By the year 2025, we anticipate this figure to increase by about 2.7% to around 26 times. Currently, the earnings per share, EPS, is approximately $239, and we anticipate it will increase by 13% to reach 270 by the year 2025. By multiplying this particular valuation by projected earnings, we estimate that the S&P 500 index will likely reach approximately 7,011 points by the year 2025, reflecting anticipated growth in the market over the next few years. This represents about a 16% upside potential compared to the current level. This is precisely why we are feeling optimistic and hopeful about the overall US stock market, particularly regarding the S&P 500 index potentially reaching above the significant threshold of 7,000 points. However, we must note that the S&P 500 reaching 7,000 points does not necessarily imply that it will rise steadily without interruption from the beginning to the end of the year, as there will likely be fluctuations and pullbacks along the way that could affect its overall trajectory. We believe that reaching 7,000 points will not be a straightforward process. It will not happen overnight. We mainly observe changes in the liquidity of the financial system. Let's take a look at this. Examining the chart located in the lower left corner of the screen, this particular chart illustrates the correlation between the Federal Reserve's reserves, spanning from the end of the year 2020 to the year 2024, and the performance of the S&P 500 index. It highlights how these two financial indicators relate to each other over this specified time frame. This situation is mainly due to the Federal Reserve actively issuing bonds, which effectively absorbs a portion of the available funds. The Federal Reserve's ongoing balance sheet reduction will also absorb a significant amount of funds. Additionally, expectations for interest rate cuts are rising in the first half of 2024. Funds are also flowing out of the banking system, and with the official start of the rate cutting cycle in September, this will become a positive factor, leading to further outflows. From May 2024 onwards, as the UP 500 index continues to rise significantly, there will be a noticeable and marked divergence in the changes observed in reserves. Look at the image in the lower left corner. It shows a vertical line. There's a light green vertical line, and at this point, it starts to diverge. This is one of our observation points. When does it start to come back into focus? Anyway, when divergence occurs, we really need to start paying close attention to the situation at hand. Another one is the image in the lower right corner, which shows the Federal Reserve's overnight reverse repurchase balance. It clearly shows a noticeable downward trend in the data over time. A distinct red line clearly represents the average level of economic activity before the pandemic, which is noted as being 306.2 billion. This means that if the overnight reverse repurchase balance reaches the average level observed before the pandemic, it suggests that the total balance is decreasing and has effectively reverted to the amounts typical of the period prior to the pandemic's onset, indicating a return to normalcy in financial conditions. At this particular point in time, we also need to focus our attention, but of course, the issue at hand hasn't arisen just yet. The third observation regarding the notable changes in the overall liquidity of the financial system is focused specifically on the domestic situation as reported by the Chicago Fed. Another important indicator to consider is the Financial Stress Index developed by the St. Louis Federal Reserve. At the moment, both indices are currently situated below the zero mark. The overall systemic risk present in the financial system at this time is currently assessed to be low. However, if it begins to reverse direction or rises above the zero mark, we must pay close attention to whether liquidity conditions may become tight or constrained in the financial environment. Basically, when the liquidity of the banking system tightens, the US stock market will also be affected. As we previously mentioned in our discussion, one key indicator is the bank reserves, another is the Federal Reserve's overnight reverse repurchase agreements, and the third consists of the Financial Market Pressure Index alongside the Situation Index. These three important indicators are compiled as weekly data, which is released once each week for analysis. These three specific data points exhibit a noticeable time lag in their responses. The financial market, as we know, is ever changing. In addition to focusing on weekly data trends, we also discovered daily short video data, which is published consistently every trading day. providing more timely insights and updates. One key indicator is the overnight reverse repurchase agreement, while the other is the credit spread associated with junk bonds. Examining these two metrics together reveals that if the overnight financing rate experiences a sudden spike, or if there is a notable rise in the junk bond credit spread, it may signal underlying economic instability or shifts in investor sentiment. A sudden and unexpected spike would indicate that short-term liquidity is particularly tight on that specific day, which could also place some significant pressure on the overall US stock market. This situation may lead to increased volatility and uncertainty among investors and traders alike. Consequently, it is essential for us to closely observe both weekly aggregated data and more frequent daily trading data in order to effectively monitor and identify any changes in the overall liquidity of the financial system. This comprehensive approach will provide deeper insights into market dynamics. All right, let's take a moment to thoroughly review our comprehensive strategy report from early January 2024, which recommended specific assets for our investment portfolio. In the previous annual report, we carefully benchmarked the S&P 500 index, which peaked at just over 5,300, failing to even reach 5,400. However, upon reflection now, we truly and seriously underestimated the situation at that time. The assets we specifically recommended were primarily concentrated in various index exchange-traded funds, ETFs. As of the close on December 23rd, our average gain was 33.8%. During the same period, the S&P 500 index experienced a significant rise of 27%, which means we notably outperformed the index during that time by a margin of 6.6 percentage points. We also do not shy away from acknowledging the reality that when selecting our investment assets, we chose a specific US Treasury bond ETF known as DLT, which unfortunately experienced a disappointing negative return of 7.6%. This decision reflects the inherent risks of market fluctuations. The primary reason for this unexpected situation is that we had anticipated a rate cut occurring in 2024. However, we failed to foresee the market's actions in front-running this expectation, leading to the current circumstances that have arisen sooner than we expected. Let's go, run far away. It is said that this particular expectation is ahead of the others. Regarding the upcoming 25 years, we have identified 6 key preferred assets that we believe will be advantageous. The first 3 are basically the same as 2024, like Bitcoin and the Nasdaq 100. Gold continues to be favorable, similar to its position in 2024. We have added 3 new categories, one of which includes American tech giants in the industry, an exchange-traded fund, ETF, that includes the 7 major US tech companies alongside the investment strategies of Buffett. Another option is an actively managed ARK ETF, spearheaded by the renowned investor Cathie Wood, which focuses on cutting-edge innovation across various sectors. Our ambitious goal for the year 2025 is for these carefully recommended assets to significantly outperform the S&P 500 and achieve exceptionally similar returns. Now, let's take a moment to briefly discuss the current situation regarding these 6 valuable assets. First on our list are Bitcoin and gold, both of which we have also recommended for investment in 2024. Now let's take a moment to update you on some key points and developments regarding these assets. In 2024, Bitcoin saw a remarkable increase of 137%, outperforming all major global asset classes significantly. Gold prices increased significantly by 25.5%, securing a strong 3rd place in annual growth. We remain optimistic about performance in 2025. Bitcoin's impressive growth mainly comes from significant interest in the US market. Trump, the newly elected president of the United States, is preparing to officially take office soon. He aims to transform the United States into a leading global cryptocurrency capital. He mentioned the importance of reducing regulation on cryptocurrency, and during the 2024 Bitcoin conference, he confidently stated that all mined Bitcoin is exclusively produced by the United States. He has firmly stated that he will never sell the Bitcoin that was seized by the government and has promised voters that Bitcoin will serve as a vital strategic reserve for the country's financial future. After Donald Trump was elected president, he nominated cryptocurrency advocate Paul Atkins to serve as the chair of the US hearings, hoping to significantly enhance America's influence in the rapidly evolving landscape of cryptocurrency applications and trading. This move was aimed at fostering innovation and ensuring that the US remained a leader in the global cryptocurrency market. There is very little hope of ever making Bitcoin a legal tender comparable to the dollar in the foreseeable future. While these goals may not be fully achievable, they at least establish strong expectations and optimism within the market. That is, there is strong support for Bitcoin among investors, but whether it can pass depends on Congress. That's a side note. In December, during a detailed interview, Powell stated that Bitcoin should not be viewed as a competitor to the US dollar. Rather, its real competition lies with gold, which has historically been a widely recognized store of value. Let's examine gold now that we've updated Bitcoin information. Gold is widely regarded as a reliable hedge against the excessive issuance and inflationary pressures of the US dollar. This excessive issuance of currency ultimately leads to inflation, creating a strong demand for the preservation of value. Additionally, as mentioned earlier, the ongoing regional conflicts in Japan. These also create a demand for safe haven assets. Central banks, including the Russian and Chinese central banks, are actively purchasing gold, a move that will significantly alter the supply and demand dynamics in the gold market. As for gold, it is globally represented on the map to our right. Now, let's take a closer look at its current market value. Gold currently holds a substantial market value of $17.5 trillion, securing its position as the leading asset worldwide. This is the highest and most prestigious recognition worldwide. The venue will soon close. Now, let's look at our second recommended asset, which is the NASDAQ 100 with the ticker symbol QQQ. The NASDAQ 100 includes the 100 largest non-financial companies listed on the NASDAQ exchange. It is a market cap weighted average of their respective stocks, serving as a key indicator of the global technology sector and growth-oriented companies in the marketplace. It holds substantial and significant investment value in the market. From 1985 to 2024, the NASDAQ 100 index has impressively increased by a remarkable 157 times. In the same period, the S&P 500 only rose 28 times. Over the impressive span of 41 years from 1985 to 2024, the NASDAQ 100 achieved positive annual returns in 34 of those years, as illustrated in the bottom right chart. It has a 53% probability of outperforming the S&P 500. Looking ahead, the factors driving the NASDAQ 100's continued rise include artificial intelligence boosting performance and the Federal Reserve's interest rate cuts enhancing valuations. With these two essential core supports in place, following 2 consecutive years of steady growth, we anticipate a significant increase by the year 2025. Another important factor to consider is the influence of tech giants. The 7 major tech giants in this rapidly evolving sector effectively serve as a valuable and enhanced supplement to the NASDAQ 100 ETF. This is due to the fact that these 7 prominent tech giants are also constituents of the NASDAQ 100 index. We strategically isolate them to enhance our investment returns, aiming for significantly higher gains over time for better financial outcomes. The total market value of these influential tech giants within the S&P 500 index has significantly increased from 6.7% in 2014 to an impressive 32% in 2024, as illustrated in the bottom left chart. This indicates that the market value of the 7 giants has been continuously growing, and their weight in the S&P 500 is also rising. From 2015 to 2024, the S&P 500 index only increased modestly by 1.9 times, whereas the 7 leading tech giants soared significantly by about 10.9 to 11 times. In other words, the 7 major tech giants are a significant driving force behind the ongoing and continuous rise of the S&P 500 index in the financial markets. We firmly believe that the leading competitive advantage of these major tech giants will continue to expand significantly over time as they innovate and adapt to changing market dynamics and consumer needs. The effect of the rich getting richer will become even more pronounced in society. Another highly preferred asset for the year 2025 is Berkshire Hathaway, the renowned company expertly managed by Warren Buffett. This company speaks for itself. It has become a legend in investing. The fund that he expertly manages serves as a remarkable testament to his exceptional operational capabilities and expertise in the financial sector. Berkshire Hathaway, who has already gone public, and the well-known company, skillfully managed by Warren Buffett, is now officially listed on the stock exchange. Over the past 38 years, it has remarkably increased by a total of 219 times, showcasing significant growth and development during this period. During the same time period, the S&P 500 increased by 20 times, nearly matching Berkshire's impressive gains. It was nearly a staggering 500% increase, which is about 10 times more, roughly speaking, depending on context. During the extensive 38-year statistical period, Warren Buffett achieved positive investment returns for an impressive 32 years. Notably, his largest outperformance over the S&P 500 index reached a remarkable 39%. Additionally, he consistently outperformed the S&P 500 in 13 of those years, showcasing his exceptional investment acumen and strategy. What happened? However, he remarkably achieved an impressive 219 times return on investment. The remarkable power of long-term compounding can be seen to be extremely significant and impactful. So this particular investment is one of the highly recommended assets that many experts suggest considering for your portfolio. Another example worth mentioning is Cathie Wood's renowned innovation-focused ETF, which targets groundbreaking companies. This particular product has been rarely mentioned in our detailed reports over the past year, indicating a lack of significant attention or focus. This is an actively managed exchange-traded fund, ETF, created and overseen by Cathie Wood and her skilled team, distinguishing it from numerous passive ETFs that simply track specific market indices. It is actively managed and continually adjusted based on prevailing market trends and ongoing technological developments to ensure optimal performance and relevance. They actively adjust the investment portfolio by increasing or decreasing positions or adding new assets. ARK's Innovative Exchange Traded Fund, ETF, takes a long-term investment perspective, strategically focusing on investing in disruptive, innovation-driven, high-growth companies such as Roku and Tesla that are shaping the future. Its market volatility can be notably high, making it particularly suitable for long-term investors who possess a certain level of risk tolerance. However, when compared to individual stocks, this actively managed fund carries a significantly lower level of risk overall. Since its inception over a decade ago, RKK has impressively increased in value by 2.19 times during the past 11 years. During the same period, the S&P 500 index rose slightly more than previously mentioned, showing an increase of 200 points in total. In 6 of those years, it outperformed the S&P 500. In the year 2020, we recorded the highest return ever, with a remarkable increase of 153%. Now, the Federal Reserve has officially entered a rate-cutting cycle to stimulate the economy, while the Trump administration has actively implemented deregulation policies. These favorable policies, encompassing both monetary and fiscal measures, greatly benefit small and medium-sized enterprises in many ways. This strategic approach significantly helps lower their overall financing costs while simultaneously increasing potential returns, which is especially beneficial for companies such as ARK that are primarily focused on pursuing high-growth investments in innovative sectors. This can ultimately enhance their competitive edge in the market. Okay, that's just about all the information I have to share with you today. Let's take a moment to see if anyone in the group has any questions. Due to our current time constraints, we still have an important discussion scheduled regarding the European market, as well as another critical conversation focused on Southeast Asia. So we promise not to take up too much more of your valuable time today. Today marks the very first trading day of the year 2025, filled with new opportunities. I genuinely wish everyone a prosperous and successful investment year in the upcoming year of 2025. Thank you all for your attention, and this officially concludes my sharing today.